What are the tax implications of mutual funds for immigrants? Imagine planting a seed in a new garden and wondering how it will grow in unfamiliar soil. When you start investing in mutual funds after moving to the United States, understanding the tax rules is like knowing how to nurture that seed for healthy growth. Mutual funds are investment pools that combine money from many investors to buy stocks, bonds, and other assets. They can help build wealth over time, but they also come with tax responsibilities that can seem complicated at first. If you become a U.S. tax resident, which happens if you get a green card or meet the substantial presence test, you are taxed on your worldwide income. That means any earnings from mutual funds, whether they are in the United States or abroad, must be reported on your tax return. This includes dividends, interest, and capital gains from selling fund shares. Foreign mutual funds can be tricky because many are classified as passive foreign investment companies, or PFICs. The IRS considers a foreign mutual fund a PFIC if at least 75% of its income is passive, like dividends or interest, or if at least 50% of its assets produce passive income. If your foreign mutual fund is a PFIC, the tax rules change. Gains from PFICs are taxed at the highest ordinary income tax rate, which can be much higher than the long-term capital gains rate. In addition to higher taxes, you must file a special called Form 1860-214 for each PFIC investment each year. This form reports your ownership and any gains or distributions. If you do not file this form, you could face penalties or extra taxes. U.S. residents also need to report their foreign financial assets if their total value exceeds certain thresholds. For example, if the total value of your foreign accounts and investments is over $50,000 at the end of the year, you must file Form 893-8. Failing to report can lead to penalties or audits. If you invested in foreign mutual funds before becoming a U.S. resident, the PFIC rules still apply once you are a resident. This means you might owe taxes on gains from investments made years ago. It's important to keep detailed records of all your transactions and consult with a tax professional who understands international rules. Some investors choose to switch to U.S.-based mutual funds or exchange-traded funds, which are not classified as PFICs. These investments are simpler to manage because they do not have the same complex tax rules. This can make your tax filing easier and help you avoid unexpected tax bills. Learning about these tax rules is a key part of building your financial literacy. Knowing how mutual funds are taxed helps you make smarter investment choices and protect your money. For Black immigrants and others new to the U.S. financial system, understanding these rules can make a big difference in your journey toward financial stability and growth.